about to do an acquisition and are wondering, what are the top tips that you should be looking out for so that you can successfully pass internal controls or SOX at the end of the transaction? Hi everyone, this is Kim Lay with A2Q2, your SOX strategist, advisor, champion, catalyst. In this video, I'm going to give you an overview of what a typical M&A process looks like. Keep in mind that your process may be slightly different, but we know that most processes are 80% the same, and the details are in the type of acquisition you're doing and the size. So we're going to take it from here. So this is just a reminder that as a public company, or when you're operating a public company environment, there's a framework of checks and balances. And the framework is called COSO. And you'll see here some of the activities, such as your control environment, your risk assessment, and control activities. The reason we need to understand what you do is we need to document it and share this process with your external auditors who are going to be checking on that you're following this process. So what are internal controls anyways? It's just a fancy word for checks and balances to make sure if someone's preparing something, there's a reviewer or an approver, and no one person can accidentally or on purpose create a transaction, approve a transaction, and fraudulently or accidentally record the transaction wrong. And in particular, we're focused in the sense of Sarbanes-Oxley in the financial statement controls. There are many other more important business implications, such as picking the right target. But in our case, I'm mostly going to focus on financial reporting implications to narrow it down. When it comes to internal controls for SOX, the three main objectives: was it appropriately authorized or approved? Was the information complete? And was the information accurate? Because eventually this goes into your balance sheet, it goes into your income statement, it goes into your cash flows and your statement of shareholders' equity. So in a M&A transaction, it starts out with sourcing the deals, sourcing the targets that you're looking at. And here there aren't many key controls at all. It starts with identifying the investment opportunities, researching the best candidates, reviewing the potential candidates for synergy and growth, and narrowing it down to the best candidates for success. And then finally, typically it's the CEO or the CFO who gives the approval for it to move ahead to the next step in terms of due diligence. So in the due diligence phase, there is something that's very important, which is going to be the approval by the CEO or CFO or the board of directors. So once you've identified the ideal target and you've entered into a letter of intent and start to perform due diligence, then there's going to probably be a series of team members from the M&A team to outside experts, whatever expertise it is that's needed to make your transaction successful. Here they're going through and doing some type of due diligence and coming down to the final, this is the price we want, these are the assets we want, these are the liabilities we want. And in which case, most companies have delegated the authority to sign significant investments or M&A, some of it to the CEO or CFO or to the board. So many companies have an approval matrix that says deals less than $1 million can be approved by the CEO and CFO without board approval, or whatever your threshold. It could be 500,000, it could be 5 million, it could be 100 million, depending on your size. That's why it's important right here. This control is to make sure that depending on the size of your authority matrix and your approval limits, there's either the CEO or CFO approving the contract or the board of directors approving the transaction, and then the CEO and CFO negotiating and approving the contract. Once the contract is signed, the deal is signed, then there's a due diligence workbook that's probably happening, and this is where the finance team gets involved to make sure that all the documents that were reviewed during the due diligence, they understand it, and you're now sending it over to the income projections, any type of deal models that you have. It's run through the FP&A team or the strategy team or the corp dev team to gather the deal logistics, the projections on how good this deal is going to be, how it integrates from a revenue, from an expense, how it impacts the company going forward. This information right here is very important because it's given to your valuation, your third-party valuation firm, and they use this information to come up with what is the price, what is the value of this transaction that you've bought. And so that's step 3 right here, preparing the valuation. The next step is going to be reviewing the valuation assumptions and results. That can be either a controller, it can be your technical accounting, or your SEC reporting person. It's probably a multiple of people doing that review. And if there's any accounting research that needs to be researched in terms of how to treat contingent payouts, in-process R&D, any type of potential impairments because we've bought something that we know we won't use going forward, that's typically the director or a technical accounting person doing that research. And then also putting together the purchase price allocation workbook. And whoever puts it together, it can be an outside consultant, it can be your technical person. It's going to be reviewed by multiple people, but particularly your controller. Of course, these titles here in terms of the roles, it can be very tailored to your organization. Typically, the controller's reviewing and review the purchase price allocation and the workbook for calculations. If there's any tax consultation that's needed, you're also talking to a third-party expert of some sort, and if that results in some changes in the allocation, it comes back here to the purchase allocation review again. And then preparing the journal entries. Once you have that, and drafting the accounting memo on the correct accounting treatment for it, preparing the journal entries. Again, it's typically this controller who's going to review the journal entries and the memo to make sure the accounting treatment is correct. Someone is then preparing the journal entries, and then typically the controller is reviewing and approving the journal entries. All of this sounds very simple, I know, but I know it's a lot of work for you, people going through the transaction itself, lots of conversations, a lot of iterative emails, phone calls, conferences. And so we've just depicted this in a very short, concise way, but I wanted you to focus on the areas that have keys around them, because whoever is in the know in the process around with the keys, that means that you're retaining your evidence of review, retaining your evidence of approval, retaining the right documentation is going to be important so that you can avoid the mistakes and easily pass SOX. Thank you so much, and we'll talk with you in the future videos where I explain the details of the top 5 tips to avoid.